Hello and welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show we work out why the stock market index ignored the Sydney lockdown today. We look at the winners and the losers from the lockdown and see how this unexpected development should be played. And we'll do that with Tribeca's Jun Bei Liu and Birmingham Invest's Julia Lee. We also look at the following companies: Seven Group, Early Pay, KTIG, MedLab Clinical, and poor Rickard tells us if we should go long Endeavour drinks in this lockdown. That's the show ahead, but first, let's just start off with Julia Lee from Birmingham Invest. Well, Julia, thanks for joining us.
Great to be here, Pete.
Hey, Julia, before we start looking at some individual stocks, I know I was questioned on 2GB this morning about the stock market. They expected the market to fall. And I said, well, you know, when you think about it, even during the lockdown in Melbourne, our market, tended to go up. So there's a good chance that we could go up. And also there's always winners and losers, and the winners can often outweigh the losers. Is that probably the explanation of why the market did go up today?
Yeah, we actually saw a pretty good session on the Australian share market. We started lower, but throughout the day, the market climbed and actually finished flat. And I like to think of this time during lockdown as buying umbrellas on a sunny day. Umbrellas are much cheaper when the sun's out shining rather than buying it raining. And look, Pete, we've been through this playbook before. When it's lockdown, what you usually see is supermarket companies doing well, defensive companies doing well. And then on the flip side, you see a sell-off in some of the travel companies out there on the market. And that's exactly what we're seeing at the moment. So I've taken the opportunity to pick up a bit more Qantas. It traded below $4.50 today, because I know that once the lockdown is coming to an end, then you usually see those travel shares bounce back. So expecting a short-term bounce back to $4.70, but also in a couple of years' time, when we're out of the pandemic, I think Qantas will be in a much better place because of the structural changes they've made, the cost changes they've made, and also, they have a very strong market share here in Australia on the domestic market.
Yeah, I'm absolutely flying the same way with you, Julia, on that one. All right, let's have a look at any other stock that you thought falls in the same sort of category, sold off today, but you like it going forward, so it's a chance to buy it at a better price.
Yeah, there was a few stocks I was actually buying today, Pete, only because the price action was quite surprising. We did see a lot of these shares sold off earlier quite hard. So picking up Qantas under $4.50 was a no-brainer for me. Also picked up some more Cube shares at $3.07. And given that we're all at home, probably internet shopping, which bodes well for freight, I think Cube will continue to do well. Was also picking up some G8 education under $1, which I thought was a bargain. Yes, childcare is probably going to be affected by the 2-week lockdown, but then the jobs market is very strong as well. They're cutting their underperforming stores, which should also help to boost growth. So G8 education under $1 was a bargain as well. So it was nice to see a little bit of volatility, but all of these shares by the close had jumped back.
Yeah, okay, great. Let's go and look at some of the companies that came through my Boom Doom Zoom show. First one is Seven Group. I must admit, I was watching Kerry Stokes about 3 or 4 years ago when the mining boom was off the boil. He was going around buying a lot of mining stocks. He was buying when no one wanted to buy. But has the company got more upside, do you think?
Yeah, I like Seven Group. If you have a look at it, it's two major businesses. It's WestTrac as well as Coates Hire. And if you have a look at the WestTrac business, well, this is all about mining capital expenditure, and commodity prices still relatively high at the moment. I guess the risk is that you do start to see the iron ore capex cycle peaking. So that's something that I'm watching very closely. But then the flip side is that the Coates Hire business, which is more dependent on infrastructure, well, we have seen the West Coast doing really well, but the East Coast is starting to kick in now as well. So for Seven Holdings, I think that the ducks are really lining up. This is probably the best sort of circumstances that they've seen in many years. And then add into the mix their strategic holdings as well. So Boral, they're looking at a 35% stake there. And, they've done very well with that initial investment of Boral. So they have been pretty savvy buyers, happy to buy close to the bottoms. And, that Boral initial investment investment has more than doubled for them there as well. So look, I think 7 holdings, all the ducks have lined up at the moment. There are some risks to keep an eye on, but at the moment, mining and infrastructure doing well.
Company called Early Pay, what do you think?
Yeah, as soon as I heard early pay, the first thing I thought, Pete, was afterpay. But then I dug into it a little bit, and this is more about lending companies money. And it's usually financing on things like equipment. And look, I don't mind this one. Having a look through the details, when you have a look at anything with pay in it, usually it's not making a profit, but this one actually is. Not only that, the forecasts for growth are relatively strong. We have a look at what they're forecasting for this year. They're actually forecasting net profit after tax and amortization of above $8.5 million. But then you look at what they're forecasting next year, and they're forecasting net profit after tax and amortization of around about $12 million. So almost 50% growth there. So that's very strong. But then you have a look at the PE multiple, and look, PE multiples in this space are commonly above 80 or 100 times. And this one's trading at around about 20 times historical. And you've got a dividend yield of about 5% as well. So look, we usually don't track smaller companies like this, but having a quick look through some of the numbers, and the numbers don't look too bad in the type of market that we're in.
Well, I'm glad to see I've actually helped you find a company that you didn't know.
I like this one, looks good.
Okay, let's get another one called KTG.
Yeah, this is one I probably don't like. You know, we mentioned the one before, EPY, and that one, you know, it's got profit, it's got the growth there, it's even got a dividend yield. But the opposite here, this company is not making a profit, there's no dividend to be paid out, and you know, revenues are still relatively small as well. If we have a look at their last quarterly release, revenue was just above $460,000. So look, too small for me, too early stage, and look, not enough of a track record. And look, they have been going for a bit of a while, but not enough track record in terms of profitability.
Okay, MedLab Clinical.
Yeah, look, this is an interesting one, and I think this is one for more of the punters. So look, they are developing something to deal with bone cancer pain. So it's on the pain side, and it's non-opioid pain, which is cannabinoid based. So they are looking to go into phase 3 trials, and we know that phase 3 trials and the path to commercialization is still probably 18 to 24 months away. But look, it's an interesting one if you want to put a little bit of a punt on it. High risk, but you know, we know that there's a massive pain opioid-based painkiller problem, especially over in the US. So this is probably a bit early stage to put too much money into. It looks interesting, but we've got to see how the phase 3 goes as well. So you've got another 18 to 24 months of volatility there.
Well, on the subject of punting, Mesoblast was always one that, you know, has always been a speculative company. Recently it started to make a bit of a comeback. Have you heard anything that justifies the comeback?
Yeah, I mean, Mesoblast was one of the great disappointments for us last year. We was looking at phase 3 results and possible commercialization, and unfortunately, they weren't successful in any of the 3 that were coming up. So, you know, it was 0 out of 3 for us, and we got out of that one. Now it's probably looking at redoing those phase 3 trials, which of course is not only a question of cost, but also a question of time. Some of its phase 3 trials have taken around about 2 years. So Mesoblast, this is very much one that tends to go well when the market's reaching record highs as it is at the moment. But in terms of the longer term story, I think it's been pushed out at least 24 months. So we got into it because it was looking at sort of the FDA approvals for 3 potential products in 3 months, but unfortunately struck 0 out of 3. So it was a loser for us.
So it hasn't got you back in. One final one. Yeah, I know you're someone who doesn't mind a good quality drink at times. Endeavour Drinks. I went down last week. Had a nice day today, I believe. Is this a company that you think's got upside?
Yeah, so Endeavour's been spun out of Woolies, and they look at the manufactured distribution of alcoholic drinks, non-alcoholic drinks. They've got the hotels business, which of course involves the pokies as well. So it's a great idea that Woolies has spun this off, because Woolies is probably discounted somewhat because of the pokey side of the business, because we know that environmental, social and governance concerns are increasing how institutions spend their money. So I have a feeling that Endeavour will probably trade at a discount to Woolies only because of the syntax side of things. But altogether, this is one that will bounce back after COVID-19 once again, when you have people going back to bars and clubs to drink. So if you do see this one coming on sale through the the lockdown period, then it is one to pick up. But today it was soaring on the market, as was Woolworths.
Yeah. Julia Lee, thanks for joining us. Talk to you next week.
Thanks, Pete.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Joining us now is Jun Bei Liu from Tribeca Alpha Plus. How are you?
I'm fantastic, enjoying staying at home, doing as much exercise as I could. Hope you're well.
Yeah, I am. And I should explain to people in other states, yes, we are broadcasting out of Sydney, as my backdrop proves. And Jun Bei Liu is locked up at home because this is a locked up city for at least 2 weeks.
That's right, absolutely. And, many states have said, what are we complaining about? We have had a good run. So hopefully the cases number will fall and we'll be out in no time.
I love an optimist like that, Jun Bei Liu. Okay, let's have a look at market generally. A lot of people said, the market's going to be down today. And I thought, well, I said to them, some stocks will go down and some stocks will go up. And the uppers have outweighed the downers, but you see some value in some of the stocks sold off today, don't you?
Oh, absolutely. You're actually seeing a lot of interesting stock all being sold off just on the back of this 2-week lockdown. So initially the market was down a little bit, and then it actually has demonstrated a remarkable comeback and now hovering around that green mark. So it's almost into the positive. Obviously on the back of that, we are seeing a lot of strength into the retailers, especially stay-at-home winners, those COVID winners. We are seeing quite a lot of strength across the e-commerce platforms. Most of them are up close to 10%, in high single digit to 10%, because people stay at home, presumably will be buying more masks and shopping more online. And even the brick and mortar retailers are up in the low single digits. So looking very strong. Staple retailers are looking very strong today, simply because, the toilet roll sections of the supermarkets now empty again. So clearly it's going to be a good couple of weeks. But what's really interesting is that there's a lot of opportunities in today. People are just dumping travel stocks, Qantas, travel agents, anything that's that's anything to do with the reopening are being sold off. TYR is another one. It's down close to 4% on the back of this 2-week lockdown. If anything, we have learned in the last 12 months that people's spending habits comes back really, really quickly, and we do expect the government to come out with more stimulus for the New South Wales states. So a lot of opportunity. Now, let's not forget the buy now, pay later sector today is down, perhaps one of the worst performing sector today, which is quite interesting because buy now, pay later is actually a beneficiary of this environment. The way I see it is that people were taking some profit off since they have done quite well and put it into the e-commerce retailers. So if anything, I think that sector represents strong buying opportunity. When the stimulus does come, I think these guys will come back quite quickly.
And also, Jun Bei, there's also some tax selling as well, isn't there? Some of the stocks that, like for example, if you're holding Nuix, why wouldn't you sell it and then maybe buy it sometime later when you think the worst is behind them?
That's right. So we're seeing two combination of everything. So the tax loss selling. At the same time, there's a bit of locking profit as well. So a lot of tech companies and high growth businesses have done very well. So people are taking the profit off the table ahead of the 2-week lockdown, just to protect the capital. So it's a little bit technical things. If anything, I think the next couple of days we should see that reversing quite quickly.
Okay, so I've got a few companies I want to throw at you. And this one wasn't on my little note to you, but Endeavour Drinks has had a good day. Now, we know when people get locked up, they drink more. That goes with a patch. But also last week, when Woolworths separated Endeavour Drinks from its business, Woolworths went up, Endeavour Drinks went down. A lot of people said, well, that's the ESG effect. ESG fund managers now can happily buy Woolworths, and Endeavour Drinks is not popular with ethical fund managers. Do you think that Endeavour Drinks has a future as a stock that is going to get better, as a lot of those rejected stocks have, like S32, we saw it with Coles, rejected in the short term, but eventually they make a bit of a comeback. Do you see that kind of thing happening for Endeavour Drinks?
Absolutely. I think the market is catching up quite quickly. Endeavour is a buy for me. Not only it's, people stay at home, it's, people drink more. It's got a great footprint. It's nationwide. It also has a reopening theme because it's got the hotels and pubs and all of that. So when the economy does come back, it's got a very good leverage to it. And it's got balance sheet is pretty good, so it can roll out and grow. Very defensive growth for not very high earnings multiples. So to me, it's a very good company. Now, of course, there's ESG issues. Now, I think that's being overplayed because the main ESG issue, I think, my understanding is that with that 10% of the earning coming from the gaming side, that is creating a bit of issue. But when you actually think about it, Woolworths, more than 10% of the revenue come from tobacco. Then does that qualify as an ESG issue? So, so to me, it is overplayed at this point. And yes, over the longer term, cost of capital will go higher for those companies with ESG issues. But for the short term, we certainly see it's being mispriced at this point. And if the company can, take the right framework and right guideline to steer away and grow other side of the earnings, you will see this business doing a lot better than what the share price is indicating.
Okay, here are a couple of stocks that people threw to us in our Zoom show. Seven Group, what do you think?
I think Seven Group is a good hold. Whether it's a strong buy, I'm not so sure yet. Look, it's done okay, and it gives a good leverage to the infrastructure spend and the like, which we have seen a lot of red tape, and it takes a lot of time to come through. And now it's in the process of buying out Borrow, so it will be a good acquisition. It has upped its bid, but we don't know if it will be successful. So if they can be successful, it will be pretty good growth avenue for this business. But at this point, it looks a little bit, kind of more neutral territory. It's more a hold for me.
Okay, let's go to a company called Early Pay. What do you think?
Yeah, look, Early Pay is it's a sort of more like almost like a factory financing, trade financing type of business. Recently raised money, so it gives a bit more room to grow. My view is that I probably will steer away at this point. My view is that for a lot of those financing businesses, when you do have bond yield started moving higher, it's not in a great environment for these guys to do business. Although it is, it's good, well funded. It is exposed to the SME space, so it will have a little bit of growth, but it's not something that I would rush into.
It certainly hasn't got you excited. What about a company called KTG? I don't know much about it. What do you know about it?
Look, I don't know much about it, but I looked into it. It actually looks very interesting.
Okay.
This is a great thing about this show. We look into those businesses going, you know what, I'm going to do more work at it. It seems to be has a special software that improve the weld rings process. And it seems to have a very, great blue chip group of customers. And it seems to be in many markets and exposed to defense spending, nuclear, and a couple of other areas. So it seems to be in the right place. And, the background of the management looks interesting as well. So it's something to follow, but it needs a bit more work on that basis.
Okay. Finally, MedLab Clinical, MDC.
Yeah, look, it's a little marijuana business looking to use that for cancer patients, using the marijuana for cancer patients. Share price hasn't really done much, raised the money already, so it's well funded to help the company to continue. I think it's still a little bit early stage for me because there's quite a lot of competition into that space. Perhaps it's more wait and watch for me.
Yeah, bit of a slow burn, this one.
That's right.
Jun Bei Liu, always great to talk to you. Thanks for your contribution.
Thank you very much. Have a good day. Bye.
I want to talk to you about the Switzer Golden Ticket promotion. Yes, our marketing department has been working overtime to come up with something great, and I think this is great. How would you like to win a free 1-year subscription to the Switzer Report with all the great stock tips that the report produces on a weekly basis? Well, we are giving you, our loyal audience, the opportunity to do just that. From now until June 30, with every purchase of my book, Join the Rich Club, which is 50% off until the end of the month, you'll enter your chance to find a golden ticket. Yes, a golden ticket, and you will win a free 1-year subscription to the Switzer Report. So if you're a current Switzer Report subscriber and you find one of these golden tickets, then we'll just add another 12 months onto your existing subscription for free. How good is that? We've got 5 of these to give away, so get in and good luck. Well, last week Woolworths separated itself from Endeavour Drinks, and surprisingly Woolworths went up and Endeavour Drinks went down. And one guy who was surprised at the fall in the share price of Endeavour Drinks was Paul Rickard. Paul, thanks for joining us.
Thanks, Peter.
So Endeavour Drinks had a pretty good day today, but do you think there's more upside?
Look, I think at the right price there is, Peter. I mean, there's a couple of things going for Endeavour Drinks, in particular, a reasonably attractive multiple compared to the market. Secondly, the prospect of, a pretty steady dividend yield towards about 3 to 3.5%. And thirdly, it's in a business that's very stable, very predictable. If you can just take away the COVID issues, which of course have impacted parts of the business differently. It's been good for, people going out, obviously, and buying takeaway alcohol, but it's been bad in terms of people going to pubs and clubs. Endeavour has a lot to offer in terms of being very predictable, very stable, and what I describe as pretty low volatility. The downside, of course, is the ESG concerns, and Endeavour not only is it the biggest operator of pubs, but it's also got more poker machine licenses than anybody else. And for many investors, that's a complete turnoff.
Yeah. If someone was holding Woolies going into the demerger, are they better off?
Yeah, they are in aggregate in terms of the two, and that's reflected in the price. If you add both Endeavour and the Woolworths share price together, you'll get that they're actually worth more than Woolworths was beforehand. So they are better off, and that's a good strategy. And a good confirmation of the demerger on behalf of Woolworths. But look, secondly, the normal pattern for demerged companies is that they do struggle for a while, and they struggle because there's usually more sellers around at the beginning because people suddenly find themselves with shares that they wouldn't have otherwise have had. Decide, look, I don't really want to own a company involved in, say, for example, poker machines and hotels and liquor shops, and get out. And there's really a bit of an absence of a compelling reason to buy. And so the typical behavior of a demerged company is that for the first couple of months, quite a bit of selling pressure, doesn't do a lot. And then a few of the fund managers say, well, that starts to look pretty attractive. And over the next 12 to 18 months, they do okay. So the moral of that story, Peter, I think, is if you're sort of probably better off to hang on to the demerged company, because typically they do well over the first 12 to 18 months, although the first few months can be a bit of a tough time.
So for someone who doesn't hold Woolworths, and this is a hard question, but someone's going to answer it, and I'm going to ask you, would they be better off buying Woolworths or Endeavour Drinks?
Well, they're very different companies. I mean, I'd probably, if I was more growth-orientated investor, I'd probably look at Woolworths because I think that there's more opportunity there. But they're also priced at a much higher sort of price-earnings multiple. If I was after income, I think I'd be more inclined to stick to Endeavour Drinks, just because I think it's a lot more secure, Peter, and probably it's the market leader in its field. It's a fairly defined field, and I think it could prove out to be one of the better income players over the next 2 to 3 years.
Okay, well, you put together our portfolios for our financial planning clients. Well, Woolworths is certainly the sort of stock you'd have, but would you put Endeavour Drinks in there going forward?
Look, not without checking with the client, because I do think that there are a lot of people who won't want to own Endeavour because of the ESG concerns. So I think I'd want to talk to the client first, because look, I mean, I know a lot of people who just don't outright have a very big problem with for example, poker machines.
Yep.
And you just can't ignore the whole ESG issue. So that means Endeavour's going to always have some sort of discounted price. But assuming that that's not a concern and they're looking for stability of income, I'd be inclined then probably to put Endeavour in there. So I think it's you've got to look at test the individual out as to just what is suitable for him or her.
Okay, let me run an idea by you. We've seen that travel stocks, Qantas, companies like that have been sold off today because of the Sydney lockdown. Is this a buying opportunity for someone who's a buy and wait for normalcy to come, whether it's 6 months or 12 months time?
Look, I think it probably is, Peter. I just put a bit of a caveat on in the sense that last year during the first part of the COVID outbreak, when lockdowns were quite prominent across Australia, look, Endeavour, like most other businesses, suffered because essentially the hotels business was just closed. And it's pretty expensive assets, and if you getting no one coming in to visit your hotel, it's pretty tough to make a profit. So they did well out of the retail sales from their BWS and Dan Murphy's business, but the hotels business was almost stopped. So if we're going into lockdowns, I think you'd have to say that Endeavour is sort of a post-lockdown recovery stock.
Yeah, a reopening stock.
I'm still optimistic that this is going to be pretty temporary. So I don't think I'd just rush out to buy it on that basis today.
Okay, Paul, on that subject, I was kind of trying to skew you into the travel stocks, but you've been, you've often said, if you're going to do in travel, you're going to buy Qantas. Qantas was a good share price, a good price today. Do you think it's a buying opportunity for the long-term holders of a company like Qantas?
Yeah, I think Qantas is in that category, Peter. I think you've got to look past the lockdowns. Qantas is going to survive. We could have another couple of years of COVID-19, and I'm convinced that Qantas will still be there at the end, and will end up with a very dominant share in Australian aviation. So I have no doubts about buying Qantas. I do have, if you're going to tell me that we're going to be in lockdown for a long time, Peter, some of the other travel companies rely upon bookings from both individuals and businesses. I'd be a little more concerned about, but I think we'll stick with the market leader.
Yeah, but I also would make the argument that probably the most important thing for the buyers and holders of these sorts of reopening trade stocks, the travel stocks and whatever, the most important thing is the vaccination rate, Paul. If we can get vaccination rates up by, say, even the end of the year, that's probably going to be good for these sorts of companies because the stock market often jumps in 6 months ahead. Is that a fair call?
Yeah, look, I think that's a good call, Peter. I think the other thing that goes with that is a bit more willingness of the government to allow people to quarantine at home. And they could make an earlier change there, Peter, without necessarily getting towards the vaccination rate. And that would at least allow international travel to start to open into these so-called green zones, because I think the biggest issue people have around the travel, apart from the concern about the getting the virus, is the prospect of having to spend 14 days in a hotel room at either end. No one wants to do that. And if you've spoken to anyone who's been through that process, I don't think they look back and say that's a great period of time. But quarantine at home is a different ball game, or quarantine with a close relative. So I think there are a couple of other things that go with that. But you're right. The sooner we all get vaccinated, the sooner at least we allow some so-called green zones or travel bubbles to open up apart from New Zealand, the better our travel companies are going to be and the better for the stock market. And it will look, as you say, the stock market always looks well in advance of these things. So as soon as it sees a realistic prospect of that, we'll see a jump in the travel stocks.
Yeah, without a doubt. Mate, thanks for joining us on the program.
Thanks, Peter.
And Paul looks at Endeavour Drinks in the Switzer Report this week. So you can go to switzerreport.com.au. That's the show for this week. Thanks for joining us.